Welcome to this explainer on the tricky accounting rules for third-party insurance recoveries. Let's dive right in. Imagine your warehouse was just robbed. You'd expect a guaranteed insurance check, right? Well, not exactly. Let's look at XYZ Corp. They just got hit by theft, losing exactly $40,000 of inventory. With a $5,000 deductible, they're counting on a sweet $35,000 payout. But booking that cash isn't automatic. We actually have to follow 4 specific accounting steps first. First up, XYZ has to officially book that painful 40 grand inventory loss on their balance sheet. Later, once it's fully approved, they can record the 35 grand recovery to soften that blow. So what's happening behind the scenes? What kind of hard evidence do auditors actually demand from you? Well, GAAP rules are super strict. You can only recognize a recovery asset when a payout is deemed probable. Meaning, auditors want direct carrier confirmation or a rock-solid legal opinion proving your claim is totally covered. Here's the golden rule. The insurer has to acknowledge your claim without a single hint of dispute. But what if they push back? What happens when the insurance company disputes it and litigation starts? Litigation creates a massive roadblock. Seriously, it flips the whole accounting script completely upside down. You're hit with a legal presumption that you won't see a dime, and you have to prove otherwise. This creates a literal night and day difference between handling undisputed claims and litigated ones. If it's undisputed, realization is probable. You are totally clear to log that recovery asset on your books. But in litigation, it's not probable anymore. You're blocked from recognizing it until the whole mess resolves. And for global companies, International Accounting Standard 37 sets an even crazier, stricter bar for this stuff. Under those global rules, the recovery actually has to be virtually certain before it counts as an asset. Look, just filing the paperwork isn't a magic wand. That certainty threshold is incredibly high. You need formal acceptance. Litigation completely shatters that certainty and throws your accounting right into limbo. So if a disaster strikes tomorrow, does your company have the rock-solid proof those auditors will demand?